Chapter 33, VWAP and Circuit Breakers. Volume Weighted Average Price, VWAP, looks at average prices over a single trading day like a continually growing moving average while simultaneously accounting for volume. You can use this indicator to identify support levels, breakout points, and resistances in an intraday movement. Essentially, the VWAP creates extremely strong psychological price levels for you automatically. Although the two look similar on your chart, VWAP often predicts future intraday price movements more precisely than standalone short-term 9, 20, or 50 moving averages because the VWAP accounts for the intraday volume of a stock trades at as a significant factor in its average price. Compared to moving averages, which blindly assign the same value to each individual period, VWAP gives realistic price value calculations by looking at the number of shares exchanged at any given intraday price level, dynamically adapting to market supply and demand. Notwithstanding, moving averages and VWAP still work tremendously together as a means of identifying significant psychological price levels in 9 to noon trades. To calculate VWAP, use the sum of all shares bought times the specific price of each share divided by the total shares purchased intraday to find the volume-weighted average price. Or, more simply, the combined total dollars traded in a single day, which is calculated by multiplying all order share amounts by their respective transaction price divided by the number of shares exchanged. So, rather than simply averaging the last traded prices, the VWAP looks at the actual perceived intraday market value of a stock based on volume. Here's an example on a 9 to noon pre-market gainer. And then we see the stock, pretty big pre-market move, and then in the morning it breaks above the VWAP, teeters below it for just a little bit, but it bounces back up, has a candlestick reversal at around 10:15, 10:10, and that reversal leads to a continuation on an ABCD setup that just crushes it. After the opening trend, add that to your initial height, and you're looking at the max profit there from about a $7 stock to $12. And then for the rest of the day, it bounces off the VWAP, but it just trails off. And then it breaks through it at about 11 and just trails off for the end of the day. In the early morning hours, the price skyrockets past the VWAP, but momentum soon slows as a short-term ABCD setup forms and the stock falls under the VWAP again. However, prices later rally above the VWAP and complete this ABCD setup right before an uncharted interior Bollinger Bands M setup, or simply a support breaking if this is a historic price level that brings prices crashing through the VWAP. If the VWAP price spread is large, then either the VWAP has to come down or the stock has to go up. This principle holds especially true during more volatile early morning hours when prices tend to come back to or break through the VWAP in large moves. After this pullback, the stock bounces off the VWAP again to pull a rapid bull run. If you miss out early on this trade, you can still enter here as long as there is enough momentum. You can judge the momentum given the number of shares exchanged daily on a stock versus its historical average number of shares traded. More traders will bring more buying and selling pressure to quickly move a stock, especially one with low float. Since you can see increasing volume bars at the bottom of the chart, you can assume that there is momentum in the stock during the huge run-up, and perhaps get in during the first 1-minute pullback. Entering on the first 1-minute pullback can be especially risky if you start off, but you can quickly enter and exit large percent gain trades by timing the first pullback in an inevitably upward movement. The trick is identifying strong momentum behind a movement and having the discipline to take profits or cut losses when necessary. In this particular trade, the stock tapered off after this morning run-up. Most 9 to noon stocks slowly trend downward after a volatile morning as traders with profits and losses leave the stock for the rest of the day. Ensure you close your positions in these volatile stocks before the end of the day, as they can be completely unpredictable in aftermarket hours. We'll talk about how to find these stocks in Chapter 36. Here's another example of a stock first trending above its VWAP but later falling beneath it. Here we see the stock breaks above the VWAP as a huge run-up and then actually conflicts with the VWAP, but instead of crashing below it, it has this huge spike up until eventually it goes into an upward wedge, falls out of it, and then crashes below the VWAP, indicating a potential trend reversal, and then as it continues below, it just sinks and sinks for the rest of the day, trading below the VWAP. Notice that the stock quickly climbs as it touches the and subsequently bounces off the initial VWAP price. This VWAP also supports the stock's initial upward movement and reinforces its later downtrend. As the stock trends, the VWAP gets closer to the actual price, providing a potential breakout or downtrend trade when the stock bounces off or breaks through the psychologically significant VWAP. Here's one last example using the VWAP alongside upper and lower VWAP standard deviation bands. You cannot add these standard deviation bands with Yahoo Finance, but you can add them in most brokers' trading platforms. We'll talk more about brokers in Chapter 37. Then we see a VWAP chart with the VWAP bands around it. So in the middle we have our central VWAP, and as you see, the price breaks through the VWAP at the beginning of the day after it bounced off of it to go up, and that breakthrough is really going to be what's going to set it all the way down to the bottom of those VWAP bands, all the way at that lowest price possible, and then it comes back up and it breaks through the VWAP again in the middle of the day at that middle line, and then it goes all the way back up to that top VWAP band. So very, very strong indicator on this day, and it really worked out well if you take a trade on either side of those trades just at that VWAP crossover. Notice that the VWAP center line acts as both a support in uptrends and resistance in downtrends. Like before, the underlying stock breaks through this line as it quickly moves either up or down. In this example, the price runs almost perfectly towards the standard deviation VWAP bands, upper and lower lines. You can use these as profit targets for 9 to noon trading, just like Bollinger Bands in swing and long-term trading. As you use VWAP with fast-moving stocks, focus on 1 and 5 minute candles to accurately and automatically find support and resistance levels in your 9 to noon trades. Just as a good limit on orders sets you up for profits, an accurate VWAP can help you set your order at the best possible price level. Stock exchanges started enforcing circuit breakers after the dreaded Black Monday in 1987, when the Dow Jones Industrial Average dropped almost 23% in one day. Also known as trading curbs, limit ups, and limit downs, these automated mechanisms forcefully halt all trading temporarily in volatile markets. Circuit breakers affect the broad U.S. stock market indices alongside 9 to noon stocks. In times of economic panic, circuit breakers give market players a forced break and reconsider large sell-offs in an attempt to decrease volatility. By understanding circuit breakers, you can learn to recognize and avoid them to protect your active and long-term investments. Without proper circuit breaker knowledge in 9 to noon trades, you can get stuck in illiquid and quickly unprofitable trades. Market-wide circuit breakers are currently based on percent changes in the S&P 500, 2018. These circuit breakers take effect when the overall index drops to a level 1, level 2, or level 3 decline, as showcased below. Note that level 1 and level 2 circuit breakers only affect U.S. markets if the S&P decline occurs 35 minutes before the market closes, whereas the level 3 circuit breaker freezes all U.S. exchange-traded equities, options, and futures at any time. And then we see the circuit breaker level 1, level 2, level 3, and the S&P 500% decline and the circuit breaker time. So for a 7% decline, it's a 15-minute halt. For a 13% decline, it's a 15-minute halt. And for a 20% decline, all trading in U.S. exchange-traded equities, options, and futures is halted for the rest of the day. Futures and options differ from stocks in that they trade outside of normal market hours. For almost all futures and options traded through the Chicago Mercantile Exchange, trading hours are Saturday at 6 p.m. Eastern Standard Time to Friday 5 p.m. at Eastern Standard Time, with a 1-hour break each day from 5 p.m. to 6 p.m. Trading hours are slightly shifted for weather derivatives, which track underlying changes in worldwide heating and cooling levels, but they are still traded just under 23 hours a day, 6 days a week. Because of these differences, many commodity futures trade with daily price movement limits. Unlike index limits, which only limit losses, futures circuit breakers also limit price increases. These limits are usually the first signal of a trend change after a 1 or 2 day maximum price movement, forecasting a reversal. Futures contract limits depend on the underlying commodity traded and are often set around 10% per day. If futures circuit breakers are triggered for consecutive days, then assets can move more the second day and even more the third consecutive limit day, just as with market-wide circuit breakers. Increased amounts depend on the underlying asset. Futures contracts that track the S&P 500 and all other global equity indices follow the S&P circuit breaker system above during market hours alongside a plus or minus 5% limit after market. Currencies and commodities do not have centralized circuit breakers since they are traded on 24-hour exchanges to provide global value liquidity, ignoring Bitcoin futures, which currently trade like an equity index, 2018. Individual stock circuit breakers halt stocks in that move over certain percentage bands during any 5-minute period. Intended to give the market time to react to extreme volatility, these circuit breakers can cause your positions in a stock to significantly drop in value when it opens back up. When the stock drops, it can reopen at any price as the exchange clear and freeze orders and investors change sentiments around their positions. Individual circuit breakers designate securities as Tier 1 or Tier 2 national market system stocks depending on whether or not they included in major U.S. indices. The two classifications have different circuit breaker percentage parameters for stocks above $3 as shown in the circuit breaker parameter chart below. Tier 1 stocks include all NMS stocks in the S&P 500, the Russell 1000, and a semi-annually updated list of leveraged exchange-traded products that average at least $2 million traded per day. Tier 2 stocks include all other securities and funds, less broker-dealer or corporation-issued options and call rights and warrants. Leveraged exchange-traded projects percentage parameters are the same as the following table multiplied by their leverage ratio. Then we see the previous close price above $3 from 75 cents up to and including $3 and below 75 cents. And then the circuit breaker parameter for each 5-minute change in a Tier 1 stock is 5% for over 3. For a Tier 2 stock, it's 10%. Then for that mid-range, you're at a 20% circuit breaker percentage. And for stocks under 75 cents, it's the lesser of 15 cents or 75%. Price band percentages are doubled during the first 15 and last 25 minutes of trading, and trading must persist outside of the percentage bands for 15 seconds to trigger a circuit breaker. Circuit breaker initially halt trading for 5 minutes. If the exchange that issues the halt still deems the security unready for trade due to significant imbalances between buy and sell orders, they can extend the halt up to 10 minutes, after which other exchanges can resume trading in over-the-counter markets, thereby reopening the stock. Here's an example of a circuit breaker halt on Planet Green Holdings Corp stock, a pre-market gainer and 9-to-noon trade. So here we see in the pre-market they had a little bit of a gain, a little uptrend, but once the market opened around 9:30, 9:40, these guys took off. They had a super big candle at the beginning, and then there was a ginormous run-up that took the stock from about $260 to $10, $11. I mean, huge run-up. So the thing gets circuit breakered, and it freezes, and then it's a really big volume candle as the market opens after 5 minutes. So the trading reopens, and then there's a ginormous drop. The price went from 11 to an open of like $5, so the stock basically halved. And if you got in that, you weren't able to trade it during the halt, and then when you opened up the trade again, you really just get messed up because you just lost all that space in between on that trade. Plag was halted after the first 15 minutes of trading, so its circuit breaker parameters were not doubled. In 5 minutes before this halt, the stock moved from around $8.50 to $11. Plag is a Tier 2 stock, since it is not an exchange-traded product or an NMS stock on the S&P 500 or Russell 1000. Since the stock closed at $267 the day before this massive movement, its maximum 5-minute percentage parameter was 20%. Using the approximate price equation below, 850 plus 850 times 0.2 equals $10.20, we find that the stock traded above its circuit breaker level up to the daily high for 15 seconds before a 5-minute halt was enacted. Notice that the volume significantly increased just before and just after the circuit breaker. On the way up, you almost always want to sell out of a position if you see a potential circuit breaker halt forming. Circuit breakers are extremely risky because you have no control or clue where stock will open after the halt. Sometimes momentum carries up into another halt, but stocks also often go through tremendous drops after halts, especially after a large run-up in a 9-to-noon stock. Note that Plag did a 25-to-1 reverse split 14 days before the movement on November 19th, 2018. Reverse splits can be huge unrealized catalysts in 9-to-noon stocks. Additionally, the stock broke through a recent resistance at 475 during this movement. If you identify a potential circuit breaker, try to exit with your profits before trading freezes. The untold price volatility risk of frozen trading rarely exceeds potential intraday returns. Remember that halted stocks cannot change price, but investors can still cancel unfulfilled orders and trade options during the halt. More rarely, stocks can halt because of more obscure news or regulatory concerns that can last much longer than traditional circuit breakers. Among others, 3 standout halts are the T12, H10, and T1 halts. All three of these infrequent halts essentially occur only in 9 to noon stocks. A notably rare T12 halt occurs when the trading exchange requests additional information from the underlying company, often after a significantly volatile trading period. The SEC can initiate a T12 halt on a stock for up to 10 business days at any time they think the investing public may be at risk. Often, prices at T12 halted stocks seem manipulated or over-speculatively traded. H10 halts occur when the SEC suspends trading on a stock. These halts can last for days or weeks as the SEC investigates criminal manipulation of a given stock. These halts are most common in penny stocks traded on OTC pink sheets, since these often poor quality companies do not meet standard exchange listing requirements and may not stay credible with the SEC, sometimes trading at fractions of a penny with exceedingly low liquidity and volume. These halts in particular can lead to extreme price drops in penny stocks. You can avoid these halts and make strong profits in these extremely cheap stocks, but you should find safer, consistent growth with 9 to noon stocks, which we will explore in Chapter 36. In an uncommon T1 halt, trading is halted as a company issues news during market hours while freezing trading during the press release to allow investors to consider their positions. When stocks make large moves based on rumors, the underlying company may issue this forced circuit breaker to release news and remedy rash investor buy or sell panics with level-headed facts about a company's fundamental growth. These halts can last hours and potentially reverse large run-ups based on speculation and invalid catalysts, or attempt to calm investors with stability as the market sells, fearful of a corporate bankruptcy. Either way, these halts freeze market liquidity and present a large risk in the very rare chance they occur, but there is little you can do to stop or predict a T1 halt. Avoid the halts you can predict and simply recognize and scale out of the ones you cannot.